Today I want to talk about capital expenditure, which you might know as Capex, and operating expenditure, which you might know as Opex. And I want to explain the differences between these two different types of money, the way that the money is categorised, which will hopefully give you an idea of what you need to be looking for when you're preparing project budgets. So capital expenditure, or Capex, is money that is allocated for buying things, physical things. So in an IT environment, that could be PCs, it could be servers, it could be the engineering time required to bring an asset into service. So really, capital is about assets, things that the company can actually tangibly own and will keep. Operating expenditure, on the other hand, is more about labour costs. It's transient expense that is used to keep the operation running, hence its name. So operating expenditure on a project might be things like travel expenses, or training budget, or hiring a room for a meeting, or providing sandwiches and a working lunch for your team. So the way that finance departments categorise money tends to be either as capital or as OPEX, and you may find that as a project you end up with two different budgets. So while at the end of the day it's all money that leaves our bank account or our company's bank account, the way that finance departments need to account for it is different, because if you're buying an asset, assets depreciate in value. So if you're buying a car, for example, at home, you might buy a car today for a particular cost, and if you sell it again in 3 years, it will actually be worth less. It's still worth something, but it's worth less than what you paid for today. And that's depreciation. So the cost of the asset devalues over time. And accounting departments need to take that into account when they're looking at what assets a project has purchased. With operating expenditure though, it's gone. You hire a room, you eat some sandwiches, you pay for a training course, and at the end of the day, then you may have something left in terms of knowledge transfer or a successful outcome, but you actually don't have a tangible asset that adds value to the organisation. So at the end of the day, as I say, it's the same cash that leaves the company, but you need to talk to your finance department about how they determine the categorisation, because some companies may decide that certain costs can be capitalised, and others may decide that actually that isn't within their regulations and they want to count that particular expense as an OPEX charge. So talk to your finance department when you start working out your budget for your project, and see how they determine within finite detail the difference between OPEX and CAPEX. You'll then be able to look at your two budgets, and you may just find that you end up with a capital budget and OPEX is handled somewhere else, perhaps in the running of the department, or perhaps in the running of the department that you are delivering the project to. Once you understand the differences, once you understand what money has been allocated to you as a project manager to manage, you'll be better placed to start asking intelligent questions around whether a particular piece of equipment that you want to buy or a particular thing that you want to do is counted as capital and OPEX, and you'll know who to ask in order to be able to process those charges effectively.